Hey everyone, this is Addy again from the Skill website and from the longshotidea.com website. Today's topic is on the butterfly spread. I am going to take you through the platform on how to trade butterfly spreads for monthly income. First of all, we will talk about the undefined risk strategy, which is called the straddle. And then we will go on and talk about the risk defined strategy, which is called the iron fly spread. And I will show you, don't get confused with the jargons here or the names here. I'm going to take you through exactly what it means on the platform, and we will discuss how each strategy works, what is the maximum profit, what's the maximum loss on each one, and then let me see if you can grasp anything, or if you have any questions on this. So let's dive straight into the platform, and I'll show you exactly what I mean by some of these strategies. Okay, so I have Microsoft up here. I am going into the 31-day cycle. If I were to trade this stock right now, I would have taken this 31-day cycle because the next one out is 59 days out. So that is a little bit too much for me. 59 days out is too much. So I try to stick around between 35 and 45 days out. So 60 days out is a little bit too much. So I would stick with the 31-day period. And this is how I would trade a short straddle, a long straddle, and then a short iron butterfly, and then a long iron butterfly. Very simple strategies. First two are undefined risk, and then the latter two strategies that I mentioned, the iron fly strategies, are the defined risk strategies. So all you need to do is just like add the wings to the undefined ones, and there you go, and then you can just trade the defined risk portion of it. So why have I chosen Microsoft? Well, no particular reason. It's just because I haven't really looked at this stock for a long time. Usually I trade the futures options, but I thought today we will change it up a little bit and then go into a stock position and then see how it works. But there's a big gap out here. I think this was the earnings gap. Look at the chart. It's just gone through the roof here on the top right, like a hockey stick chart. Volatility is completely on the bottom. So I would not trade this stock. If I were to trade any stock, I would not pick Microsoft because of the volatility here. Look, there's no vol anywhere. So if you sell options here, you would not get enough premium. So that's the reason why I would not pick the stock for selling premium or short strategies. Now, for a long premium strategy, yes, maybe this is a good candidate where you can, pick some premium and then stick with it and then let it run on the upside. Now, anyway, back to our strategy. So, what is a short straddle? Short straddle is when you sell the at the money strikes. So you go on and right click. At the money is 475 right now. The stock is trading at 476. Totally fine. Just $1 out. You would sell not a single, but you would go and choose a straddle. Okay. Choose a straddle. This straddle means you are selling two options at the money. You are selling a call and a put option at the money. And then the way this looks like is it's not a complete butterfly, but without the wings. So you can look at the chart here. It's right at the money in the middle, right? Right at the money in the middle. And let me just select the break-even points first. So you set slices break-even. This one expires on 7/19. So you got to make sure that this top part here is also lining up with your 7/19 date. Otherwise, your charts will not line up correctly. Make sure this is I always look at it as probability range as one standard deviation. You can go in and change to 2 or 3, but again, if you go out that far, you don't get enough credit. So I stick to 1, trying to collect enough credit, try and cover one standard deviation move, and then see how this stock goes from there. Okay, so this is your upper break-even point, and then this is your lower break-even point. Now, what does that mean? So the stock is trading here at 476. Add the credit that you're collecting, which is $20 or something, $20.55. Add that $20 on both sides. So that's where your break-even points are. So from 476 up to 496 is your upper break-even. And then from 476 minus $20 on the lower side is your lower break even. Meaning only after these points you will start losing money from now on. Okay. Now let's look at the Greeks of this trade. Now you are short delta a little bit because remember we are not exactly at the money. So you are collecting, and the reason you're short delta, usually you would be flat delta because you're selling both sides, but here you're selling 44 delta here and then 56 delta on the call side. That's why the difference is 12, right? You look at this number. Let me take out my pen here. So look at this number, 44, you're selling 44 delta on the put side, and then the same strike on the call side is around 56 delta, and the difference is 12. And therefore you are collecting 12 negative delta overall. That's this number. Your gamma is pretty much flat. I wouldn't really worry about the short gamma position here. -3 is totally fine. Okay, short theta, where does this 32 comes from? Now the 32 comes from here. Again, look at the theta column. I always have the theta column in my view on both sides. So you're selling 19, let's say you're selling 20 theta here, and then you're selling 14 theta here. So that's the 32 that you're getting, okay? Probability of in the money, other checks that I would do here is like open interest, yes, in thousands, perfect. Volume is on the low side, which is totally fine, not a problem. And look at the open interest here on the call side as well. Anywhere within this range, your open interest is really good, right? If you go further out on the call side, you lose. If you go further out on the put side, if you go up a little bit, you'll see the open interest is not that great on when you go further out of the money. Too far out of the money, you don't get enough open interest, but that's fine. Okay, let's analyze this trade one more time. So we've talked about, and then we're short vol, because whenever you sell options, you are short volatility. And that's what this is. You're short Vega. Again, where is this Vega coming from? Short 112 Vega, again, coming from here. I always have, I don't have Vega here, but I should bring it in. I don't have it here. Okay. I can bring it in from this thing. So always, I thought I had Vega here, but customize. Let me bring in the Vega column as well so I can show you what I mean. And bring this up a little bit. Okay. So now I have the Vega column as well. Vega is the volatility of each strike. Look at this. This is the put side, and then this is the call side. So you're selling at the money, which is an easy pick. So you're short 55 here, and then you're short 55 here. So that's an overall 110 or 112 that you're getting, right? Does that make sense? Because it's positive Vega here, positive Vega there, but you're shorting all of these. Vegas is always positive. Look at this, numbers all the way down. But you are selling this option, so you're picking up negative Vega, okay? So always remember that. So that's your short Vega, that's where it's coming from. Open this, okay. Now, another thing I wanted to show you. So this is the short straddle, fine. Your max profit is $2,000. Look at this line here on bottom left. Focus on this thing when I hover over this chart. So 475, you are collecting $2,000, 2020, because that's what your max credit is. Whatever your max credit is, that becomes your max premium received or max profit, okay? Now your max loss. Now remember, max loss is unlimited here because the stock can either go up or down to zero on both sides. So the margin that you will be charged on this strategy will be similar. So $2,000 here. Oh, why is this not letting me sell? Illegal 100 shares. What does that mean? Now, for some reason, it's not letting me sell this. Let's see, what is this? Uh-oh. Okay, for some reason, it's not letting me sell it. But your buying power effect would be based on the worst case scenario. So whether the stock goes up or down, that's how much credit you will be charged to open this position up. Depending on how your margin is set up with your broker, that's how your margin position will be. That's your buying power effect will be. Now let's do I've shown you the short straddle. Now let's go and look at the long straddle, right? It's the same trade. And instead of selling, I'm going to buy this. So you'll see the exact opposite of it. Analyze this trade. Same thing, exactly the same thing. Now you need the stock to go up on either side and keep going up or down on either side, right? I don't mean up, but either way. This is you're picking, everything is reversed here. So you're picking positive delta, you're picking negative theta, and then you're picking positive vega, meaning from here on, you want the volatility to tick up. This long straddle strategies are good with earnings plays. Why? Why do I say that? It's because either way, when the stock moves, you make money on the delta or the other direction of it. However, you lose money on theta and vega, because vega then gets crushed after earnings. It doesn't get picked up. So pre-earnings trades, slightly before earnings, 3 to 7 days before, this would look good, because from there on you will have some uptick in the volatility side, and therefore this kind of spread could actually make you some money. But I don't trade long straddles because it ties up too much capital and it needs a lot of movement for you to make money, right? You need the stock to go somewhere after your break-even points to actually make money on this. So not a great vehicle to trade for me, at least. Now let me take you through an example of an iron butterfly. What do I mean by iron butterfly? So instead of just selling a straddle, we will sell a butterfly. This is the butterfly. Actually, this is not the right one. Maybe we can sell. There isn't a predefined iron. Let's look at iron condor, and then I'll show you exactly what I mean by iron butterfly. So we just have to change some. Instead of selling out of the money, we'll sell at the money. Okay. So at the money is 475. You look at this put option is at 475. You just need to change the call option to the same point, and that becomes your iron butterfly trade. Did I do this wrong? Yeah, I changed the long call. I need to change the short call. So this is the short call. And then the long call would be, let's say, $10 out. Actually, let's set this up again for the iron condor. Let's bring this thing up again. So short call needs to be at 475. Now this is showing you a broken wing, which I will discuss later. This is a broken wing butterfly, which means it's an unbalanced butterfly trade on at least one side. Now, the way I set up a short iron butterfly is you sell at the money at 475, then you go maybe $20 out. So from 475 to 450, $25 out. Or maybe to 455. So let's say if you can pick up 455 on the call side, on the long option. So I'm selling it at the money, and then I'm buying at 20 delta, right? So remember that I'm buying at 20 delta, I'm selling at the money. I need to buy at 20 delta on the long side too, which is $500 strike. So I'm going to go in here, and then on the put side, on the positive thing, I'm going to buy 500. The 500 strike. So that gives me about 18 delta, right? Okay, so now look at this trade. Okay, so the reason now this is a little bit unbalanced is because you have a $20 wide spread on the call side, but you have a $25 wide spread on the put side. So let's change the call side to 25 as well. So I'll select. We short 475. I'm gonna short 470. I'm gonna long 450 here. Okay, that's a regular butterfly trade. Now look at this. You are risk defined on both sides, and then you are collecting. Let me bring this down to 1. So we can check the numbers. Okay, so this is the short iron butterfly trade. Perfect, good setup. Here's the problem with this one. Because you're selling at the money, you collect a lot of credit. I get it. But then you don't have enough room to move from where it is right now. With a strangle, you start out of the money and then you have more room to move. With these straddles, your max profit collection, or at least for me, it would be between 15% to 20 to 25% max. I would not wait until 50% of premium decay as I would wait in a short strangle trade or a short iron condor trade. Here, because I'm selling at the money, I would take profits off the table when it hit 10, 15, 20%, not 10, 10 is low, 15 to 20, 25%. That should be my, threshold here. Now, again, same thing. Let me show you some Greeks here. Remember to change your break-even points. Let's bring the chart in. Your max profit collection is $1,400 because you are collecting on both sides. Your max loss is $973. So this is better reward to risk, yes, but the probability of this happening is lower than your short straddle. So it's around 50% probability because you're selling at the money, right? You don't have enough room to move. There are some techniques and adjustment mechanisms that you can use to roll this trade out, but again, that costs money. So I'm not a big fan of iron flies because you start at the money, which I don't like. I like to be further out of the money and then sell there. And then you have more room to go from there on. Okay, max loss is $1,000. Max profit is $1,400. So that's a good risk reward here. And then let's look at what else? Some Greeks. Okay, so you're almost flat Greeks. Fine, negative delta a little bit, 15. Your Vega is slightly, because you're selling options, we are short Vega. So that's 48 short. And then your positive theta because you're selling bigger theta than what you're buying on the wings. These are called your wings. Your break-evens are basically whatever your strike is minus your premium collection on both sides. So take a look at that. And then that's it. This is a iron butterfly trade for you. If you want to, start doing this small, I would suggest you pick up a small stock, not a big stock like Microsoft, which is trading around 500. Pick Apple, which is around 200, a good liquid stock. That's, really high open interest and high volume, stock that is. So it has good options volumes as well. Pick that stock up and then sell one at the money straddle with the wings. So call it an iron butterfly. Start dipping your toes in this world, in the world of at the money strikes with a short iron butterfly trade, and then take profits off at 5, 10, 15%, wherever you're comfortable for your first trade. I would suggest starting on the paper trading account first, and then move on to your other real live trading account. So that's how I would go on about it. Any questions, just let me know, please. Thank you very much.